Hello and welcome to my channel. So in this video, I will talk about 4 key rules of thumb that you need to keep into consideration when you're purchasing a car. Now this video is part of my personal finance series on rules of thumb, where I've made various videos with regards to rules of thumbs pertaining to personal finance. Let's say rules of thumb for purchasing a house, rules of thumb for purchasing a car, rules of thumb for budgeting, rules of thumb for saving, investing, and so on and so forth. In order to access the full series, please click on the link above. Also, I will leave the link to all those videos in the description. Hi, my name is Behroz. I am a finance executive by profession and a personal development and growth coach by passion. In case you like the video, please don't shy away from pressing the like button. Also, press the subscribe button and the bell icon along with it so you can subscribe to my channel and get notified as soon as I put out a content on this channel. So now let's get going with these rules of wisdom. The first rule is called the 10-year rule. This rule is to do with whether you should buy a new car or a used car. So if you want to maximize the value of your car, you should go for a used car, or otherwise buy a new car but use it for 10 years. The idea behind the rule is that the car loses 20% of its value in the first year, and in subsequent years it loses 10% of its value. So if you buy a used car, that first 20% of the depreciation has already been knocked off from the car. But in case you buy a new car, then you drive it for 10 years, because in that case you would have optimized its value and the depreciation won't matter anymore. Now, one word of caution. A new car is more likely to break down and require repairs. You need to make sure that the cost of maintenance isn't more expensive than the value you get out of using a used car. Rule number 2 is always to pay cash when purchasing your car instead of financing. Paying interest on an asset that is depreciating is like losing twice. One, you lose because you are paying more than the value of the car in form of interest. Second, you lose because the asset is depreciating and losing its value year on year. Now, in case you don't have the luxury of buying a car on cash, here comes the third rule, which is 24-10 rule. According to 24-10 rule, you should put at least 20% of the car's value as down payment. You should not finance it for more than 4 years, and you should not allocate more than 10% of your net income towards payments, which includes principal, interest, insurance, gas, maintenance, etc. Now, this may limit your means to buy a nice vehicle. However, it will make sure that you don't make any stupid decisions. It will keep you buying a vehicle that you cannot afford. Cars are expensive to maintain, and this rule takes into account your ongoing expenses related to insurance, payments, principal payments, interest payments, gas charges, etc. Under this rule, a person who is earning $50,000 of net income after tax can afford a car payment of $417 per month for 4 years if they have put down at least 20% in down payment. So now moving to next rule. According to rule number 4, a car's total lifetime cost is 3 times its sticker price. So for instance, if you're buying a car for $10,000, it will cost you in totality $30,000. $10,000 is your original purchase, and $20,000 on top is the cost of insurance, maintenance, and so on and so forth. So for instance, if you're purchasing this $10,000 car and keeping it for 5 years, that means that you would be approximately incurring $333 per month for the amount of period, which is 5 years, that you will be keeping the car. Thanks for watching this video. Hope you enjoyed and learned a lot. In case you did, please do press the like button and also subscribe to my channel so you get notified as soon as I put new content out there on this channel. Thank you.